Hi, Brian Evans here. I wanted to take a few minutes to talk about this last year and some of the things that we're looking at going on in the market and just check in with you. So here we go. Just a brief recap of last year. I think most people would agree on the investment side of things, it was very successful for most of us. We had certainly a lot of pain during the year, lots of struggles. I won't get into all of that. But as we look at least at our investment returns, especially in the market, pretty good across the board. I will say though that it was certainly a market of the haves and the have-nots. Much like this recovery is a recovery similar to that. They call it a K-shaped, where some of it's going up and some of it's going down. Depending on what industry you're in, you either are very successful, even in spite of COVID or maybe because of it, and other areas not so much, the opposite effect. Last year in the S&P 500, if you own technology shares and telecom shares of stocks, you did well because they attributed 2/3 of all of the gains of the S&P 500 were attributable to just those two sectors. So if you didn't have a lot of those two sectors, you didn't do so well. So that was it, haves and have-nots. We were pretty heavy in those. We certainly had some good timing early in the year. I've already discussed that in previous messages where we, during COVID, reacted during that. And post-COVID, we went heavy in particular sectors. Some did very well. Some did okay. Most of them did quite well. For instance, the NASDAQ technology shares, the semiconductors, the biotech, and the telecom that we got into certainly did well. Gold didn't do a whole lot. We did get out of some things that weren't doing so well. So one of the things I wanted to share is just kind of a look at our standard model portfolio. This isn't necessarily something you own, but it's an approximation of what we're in. As you can see, we're generally a lot of people have this particular portfolio. It's called the growth portfolio. We have a lot of money in stock market in this, and most of it's in US. Certainly mostly large cap stocks too, although we do have small and mid cap here, and they've done actually quite well too. We don't have a lot of bonds, 18% in the portfolio. Typically these kinds of portfolios carry about 40% in bonds, but I like to accomplish our security in different ways using, for instance, fixed index annuities. So one of the other things I wanted to show was just kind of the breakdown of what we have in our portfolio versus the S&P 500. And as we can see here, we're very heavy in technology shares and healthcare. Those are two big ones. Then we have communication services, the third. I think most people would agree that those have been good areas to be post-COVID. They were not negatively affected too much. We're underweight in other areas, although I'm going to make some adjustments going forward. You'll notice I'm underweight in real estate. It's not that I don't like real estate. It's just that we do our real estate in different ways. We use not ETFs for that, but private non-traded REITs and DSTs. So a different kind of real estate. And I'll get into why in a minute. Don't have a lot in energy, although I'm going to make an adjustment there, I believe, so in the near future. So we have this mix that I'm paying attention to. I know what we're overweight in and why, and we'll just kind of keep our eye on the prize. Now, some people might say, well, gee, are you sure you should have so much money in the stock market? And I go back to an article I wrote 4 years ago plus for Kiplinger, and the market at the time was about 19,000. And my title of mine was when the Dow will hit 50,000 and why. And it's just a math equation. So I just extrapolated from when the Dow was 1,000 forward at 7% a year, which had been the long-term average of the Dow. And it hit 50,000 in the year 2030. And at the time I wrote the article, it was kind of spot on to where it should have been. Now, the problem, though, with the markets are that you can go long stretches where you don't have any returns or you have negative returns. That happened over the 13-year time period from the end of 1999 forward. if you were in the market, all you saw was it lose a ton of money, finally get it back, lose it again, finally get it back. And it took 12, 13 years to get there. If you're in retirement pulling money out, that doesn't work. So markets are great. If you have time on your side, Dow will probably hit 50,000. But if you need the money while, to live on, you don't want all your eggs in that basket. So I want to point that out. On the real estate side of things, uh, we generally had a very good year. Real estate across the board was particularly hit uh, with COVID. And as we look at the stats, I pulled this stat up on publicly traded REITs. They didn't do so well. They did terribly, in fact, for last year. It was a very difficult real estate market for these. Now, I haven't been buying publicly traded REITs in our portfolios because I find that the composition within them was put together a long time ago, and they might not be in properties I want now or new properties. They're constructed, like I say, a long time ago. And so with the private non-traded REITs, we're able to target specifically where we want to have our money. And I think that we've seen some real success with that. That we can be a little more proactive in how we invest. What I've seen is some of our REITs did extremely well, and some of them had a write down, but recovered. And there's just a couple that are still trying to get back to where they were before, but we haven't really lost money overall on them. And so, uh, I I wish that all of our investments always made money and were positive. They don't always get there, but as you can see, the only areas that made money were self storage and industrials. Now we have a lot of industrial, and if you have Blackstone, what's not on here, Exchange Right, they did extremely well and had a write up after COVID. They're in necessity based retail as opposed to regional malls or shopping centers, which did the worst. We picked the one area within the subset within this area that did extremely well. Uh, we've done again well with other things that we've had to. So we're not having these kinds of negative returns. As you look at your statements, most people were pretty impressed with how their real estate did, especially when compared to publicly traded real estate. So I wanted to point that out. We've had a change in administration, of course. There's a lot of tax proposals being kicked about. Don't know where they're going to come out or when. Certainly, capital gains could be going way up. Step up in basis could be eliminated. Estate taxes could be hit more people. 1031s could be taken off. Don't know if or when these are going to happen. I suspect some will. Seen proposals to not only take capital gains rates from 15 to 23.8 right now to up to actually 52%, because if we have a 39% bracket and the 3.8% Medicare tax on top of that, and then if the state of Washington adds another 9% tax, which Governor Inslee wants to do, we could you could sell your property at a gain and give more money to government in taxes than you take home. And I don't appreciate that too much because capital gains are also really a tax on inflation. So once you factor in inflation, your gains aren't very good. People aren't going to want to invest. It's going to hurt our economy. Don't get me started on this topic, but hopefully that won't come to pass too bad. And some of these may pass and some may not. As I mentioned on my radio show, I mean, if they jack up capital gains rates, but leave 1031 exchanges and step up in basis, then I'm going to be like a Starbucks guy at the counter taking orders for DSTs, Delaware Statutory Trust, because nobody's going to want to pay that 52% tax that's potential if they can still roll it over. But if they eliminate 1031 exchanges, I'll be the Maytag repairman. I won't ever get a call because no one will be able to do an exchange anymore. So we'll see what happens with that. A lot of people are really worried about income tax rates going up on them. I've had to remind a lot of folks that you're not really the target market. If you're getting, if your taxable income's 100,000, plus or minus, your taxes probably aren't going to go up immensely. they're not going to put the 40% bracket on a family making 100,000 a year. They're just not going to. They're going to go after people that are making more money, and they're going to try and get clever with how they get it. Like I say, eliminating capital gains treatment on inflation and step up in basis and that kind of thing. um, they'll try and get it in other ways. So for many of you, you're not the target. Relax. If you do have questions about what your taxes might be under certain scenarios, certainly give us a call. We can help work that out for you or alleviate your concerns, or just kind of let you know what's coming down the road. Um, Again, I mentioned I am looking at other investments. We've done quite well with the sectors we're in. I do suspect, though, that I've seen all the data on green energy requirements for states, where they're going to mandate that you have 50%, 75%, 100% of utilities, public utilities using green energy. And I'm thinking, ooh, where are you going to get that? You're all going to have to buy it, and there's only going to be a few people that have it, because there's not a lot of wind turbines in Washington or solar panels in Washington. Where are you going to get it? And so it occurs to me, my old basic econ 101 says if you have a huge demand for something and limited supply, price goes up. And so I might be looking at a green energy investment related to that. I also think that we've had a really great run in the U.S. stock market, and a lot of people want to know why. Uh, and that is confusing. We're in a recession, a global pandemic, and yet the markets are at all-time highs. Why? Well, one of the reasons is we're not investing in the economy. The economy is in a recession. The stock market is different than the economy. They're related, but they're different. The economy is the local stores and people that own restaurants and people that that work for a living. The S&P 500 is Apple and Microsoft and Google, Facebook, Amazon, Johnson and Johnson, Nvidia. These companies are doing great post COVID, and so that's where the money is. And so that's why your market can be going up. Also, markets are forward-looking indicators. They're actually pricing all the stuff that's going to happen. We all know there's going to be a vaccine. We all know restaurants will reopen. We all know that people will start traveling again. That's already built in the markets, and so they're forward-looking next couple years, not the next couple months. And so that's all in there. But as such, we do have to be wary that the markets can get a little heated up. I think they're probably pretty highly fully valued right now, although we're going to have quite the recovery. I think there's a lot of pent up demand. So keeping my eye on that too. Finally, I just wanted to mention I've gotten a ton of positive feedback from folks. Um, when markets are up, everybody thinks I'm a lot smarter than I am, and all of us at the firm. And when they're down, they think the opposite. Neither is probably true. We're somewhere in between. We've had really good growth of the firm, success there. We've added 3 new advisors, Andrew, Matthew, and Michael, and we welcome them. Christy and Joel have been taking over more management responsibilities. All of this is good. Growth is good, because I used to have to do everything, and I couldn't, and I had to spread myself out pretty thin when it was just me. But now that I have all these wonderful folks and the best support staff there is, bar none, for an advisory firm, we all work together, and it helps me. It's been freeing up my time to spend more time researching your investments, to come up with ideas and strategies. You probably noticed this last year. So actually, as we grow, I have more time to give to you the investment research than I did when we weren't growing as much. So appreciate those referrals. Keep coming in. Please do send them to us. We're certainly, if you think somebody would benefit from working with us that has 500,000 of investable assets. I know you can't just ask them that kind of question, but you might have a sense for that. But we do appreciate those referrals and want to continue to grow and service more people. So with that, hopefully that was helpful. A little update on many different topics here. Keep it quick, and let us know if you have any follow-up questions. Appreciate the support and look forward to chatting with you soon.